Hello and welcome. Moth Adams is pleased that you joined us for today's webcast, GASB 96, Impacts on Tribal Entities and Implementation Tips. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn the floor over to the presenters for a brief introduction before we get started.
Okay, hello everyone, and thanks for joining us today. My name is Libbe. I'm a senior manager in our tribal and gaming group, and I've worked on tribal audits and casino audits and tribal enterprise audits for about 12 years now, and I'm really excited to share some tips and tricks with you guys on implementing GASB 96 and how we can apply lessons learned from implementing GASB 87. And I have with me today Jason Ellis. Jason, you want to introduce yourself?
Hi all, thanks again for joining us today. I'm a manager in the Tribal Services Group. Been working with tribes for about 3-4 years now, and been working with governments in general about 8 years now. So definitely been in the GASB world for a while now. Okay, so kind of jumping into our objectives today of what we're going to learn. So first, be able to describe how the new subscription-based information technology arrangements, or SPITA, standard changes accounting for such arrangements. So that's the GASB 96. Identify the accounting disclosure requirements under the new standards. Discuss lessons learned from implementation of GASB 87 releases, and then kind of describe some implementation strategies and best practices to help you get started in the process. So kind of the way we're going to break it out today is first we'll kind of go through the scope, terms, timing, and overview of the standard, give everyone a refresher, give a refresher and kind of a overview of the standard, and then we'll look at how to prepare for the standard, and then those lessons learned from GASB 87 that can be applied to 96. And then depending on timing, we'll get to a Q&A. Feel free to ask Q&A throughout the presentation. We'll try to answer them as we're going along. Otherwise, we'll try to do it during that Q&A section. And if we don't have time to get everything, we'll try to get back to you after the presentation. And now we have our first polling question of the presentation.
Great, thanks, Jason. Polling question number 1. How prepared do you feel to implement GASB 96? And I'll give you all a few minutes to respond. To respond, please click on the button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide area. Okay, we'll give everyone a few more seconds here. And here are the results. So back to you, Jason.
Yep. Yeah, so definitely. So it looks like we have a lot of people who are kind of really starting to dive into the standard and work towards that. And then we have some people that are in the preparation phase and kind of just got a lot more to do on that. And then we have a few people that have already got adopted and are good to go. So I think we're in a good spot, and we'll definitely try to go through it, really kind of help you guys understand the standard and give you guys that kind of introduction so you can start working through and getting prepared for it. So once again, so looking at kind of the scope, terms, and overview of the standard. The objective overall of GASB 96 was to better meet the information needs of financial statement users by establishing uniform accounting and financial reporting requirements for SBITAs, improving the comparability of financial statements among governments that have entered them, and then enhancing the understanding, reliability, relevance, and consistency of information about them. In terms of timing, so the standard is for all reporting periods beginning after June 15th, 2022. So this will be effective for all of our year ends starting at June 30th, 2023, as well as the September and then our fiscal year ends. When you do adoption, it should be applied retroactively by restating all prior periods presented if practical, or you can show a commutable effect, which reported as a restatement of beginning net position for the earliest period restated. I feel like probably most people are going to go for just showing that cumulative effect rather than having to go back and go through the analysis for multiple years. Both are totally fine under the standard to do, totally up to the preference. So kind of breaking it in. So what is a SBITA? So this is a contract that conveys the control of the right to use another party's IT software alone or in combination with some capital assets as specified in contract for a period of time, and it does require an exchange or exchange-like transaction. Determine whether a contract conveys control of the right to use. One, you want to look at the contract to make sure that the assets are specified in the contract and that that you have for a certain amount of period. And then you also have to, it has to determine that the nature and manner of use is up to the user. You have the right to use the software as you want, get within the parameters of it. Definitely is risen in popularity with all of the cloud computing and storage arrangements that are out right now. And if you do notice, kind of jumping into how 87 is similar, that idea of control is very similar to 87 on terms of how you determine if it should be on your balance sheet or not. So for some examples, there's a lot of software that tribes and gaming entities would have. So you can have some game-changing technologies, quick custom intelligence products, including host slot marketing software. You can have your sportsbook software, sportsbook betting platform, Amadeus sales and event management. For more for the tribal governments, especially there could be subscription to Microsoft Enterprise licenses for desktop software, server, and other software. And a lot of times these could contain multiple elements. So you could have the subscription to the server, as well as maintenance and support of Barracuda or Microsoft 365. Generally speaking, you should be looking at each element separately, unless there's some reason that you can't break it out, which we'll get into later. And then also, there can be some that are excluded as short-term contracts, which we'll be getting into later as well. And then another kind of example would be a 3-year subscription to Adobe Campaign Standard. And then kind of our catch-alls in there. So you got accounting software, inventory software, point of sale, cash management systems, cashless payment systems. And kind of really important one is to really think, especially because a lot of us here are accountants, is really consider what is getting used outside of accounting that you might not realize that's being used. So like if you have a clinic or health facility, there's probably going to be some patient and billing software being used. There could be some project management software being used on the operational side. So kind of one of the really important things to do when you're kind of going through your inventory is to make sure to reach out outside of accounting to make sure that you're getting a complete picture of what would be in there. And then also another example actually would be a lot of the software that supported GASB 87 calculations will work for 96 as well. So you could need to account for the software that you're using to calculate 96 as well in the software for 96. So what isn't Thibodeau? What kind of falls out of the standard? So if a lease is scoped in 87 and the software component is insignificant to the total cost of that asset, then you would not consider it a CEBA and it would just fall underneath that 87. So an example would be like a computer with an operating system or a smart printer that's connected to an IT system. Standalone IT service contracts. So these are you pay for a 3-year contract with an IT support group that will come in and do maintenance on your servers, help with tickets and that kind of items. That wouldn't be fall underneath that. That would just be a standard contract accounting. Agreements that provide outside entities the right to use their own IT software and associated. So that's going to fall under your internal software. And then contracts that fall under scope of either 94 or 51. So that's the public-private and public-public partnerships. And then the accounting and financial reporting for intangible assets, like we mentioned on the internal software. And then also there's short-term contracts or arrangements. So if it's 12 months or less, you do not need to record it. It's pretty similar to 87 there. But you do have to take into account any non-cancelable. You have to add any options to extend for non-cancelable periods into that. So you can't just have a year contract that you just keep. You have the ability to renew, and you will renew. You plan to renew every year after year, and not record that. In terms of kind of that non-cancelable period, so basically that means that cancelability is either party at any time can revoke the license, and then there could be a notice period, but as long as that's under the 12 months, then that would count. And that would be so if they could revoke your access to the software at any time without having to talk to you, or you could cancel it and get a refund for the unused period. This doesn't include if you get canceled for non-payment, because that's more of a breach of the contract versus really a cancelable of the contract. So and then, as I mentioned, kind of the hardware purchase of software wouldn't be included in that. And then whether it's 87 would fall under 87 for just the equipment. Would kind of depend on whether you purchased or leased it. So, and then like I mentioned, so supportive maintenance agreements. So say you purchase, so say if Tribe purchases an inventory software and you pay an annual support and maintenance fee, that maintenance support and maintenance fee wouldn't be SPITA because it, like as mentioned, it's that contract to just provide maintenance and support. Let's see. Kind of jumping in. So as mentioned, GASB 87, very similar, around 96. Kind of so some of the similarities is really like length of the contract. When you look at the length of the contract, you are going to start with non-cancelable period, and then you're going to add any periods that you have the option to extend if you're reasonably certain that that will happen. Or if you're reasonably certain that you would terminate after, then that you would not include those. It does include a discount rate, so part of that is going to be reduction of the liability, and then part of it's going to be interest expense. So you can either use the rate that's implicit in the agreement, which, given that most leases that usually wasn't the case, it's going to be very hard to find them in software contracts most likely. So you most likely need to use a incremental borrowing rate. And that'd be kind of similar to same thing for 87 on where you're looking at how much it would cost you to borrow money and then applying that in a consistent manner. Then also there's the measurements for recording assets and liabilities. So much like you had a right to use asset with the lease standard, you now have a right to use software asset. And then you have a related liability for payments. And then there also is disclosure requirements, additional in there, which we'll get into in a little bit. And then bifurcation of contracts containing multiple components. So kind of jumping in to the subscription liability. So this initially is measured at the present value of subscription payments that will be made during the period. So you're going to include fixed payments. Variable payments depend on an index or rate. If it's a variable payment that's based off future performance, like an example would be if you have a software contract that you have to pay a certain amount per seat that's using it, you would not include that per seat fee because that's based off of how many you're going to use in the future. You're not able to reliably say. If there is like a minimum on there, so say it's $10 per additional seat, but $1,000 minimum per month or year, then you would include that minimum in that. And then variable payments that are fixed in substance would be in there as well. And then any of the payments that are associated with the contract that are reasonably certain being required. So if you have some fixed payments down the line that you know you'll need to make, and then mention the discount rate. So that's going to be your implicit or incremental borrowing rates. And then so as you're kind of amortizing this liability, you'll be recording that interest expense for that discount portion. Yep. And I guess actually I think so we had a couple questions we could probably jump into. So in terms of kind of materiality threshold policy, so we'll get into kind of talking about policy, but definitely much like GASB 87, you can make a threshold. You can make that threshold, materiality threshold on there. I would just say when you're making that, just double check. You probably want to just double check with your auditors and everyone to make sure that everyone's kind of comfortable with that materiality. And then in terms of if it applies to the fund financials, so these are, okay. Then also we had a question on, do the lease standards apply to the modified accrual fund financial statements? So these would be for the overall government-wide, much like regular assets, similar to 87. And then someone asked, does this include the Square point of sale system? I would think if you're paying a certain fee over time for use of that, that would be included. Though you wouldn't have to account for any like transaction fees. You wouldn't have to estimate how many transactions you're going to have over a period, how much of a fee you'd have to pay for that. So if there's overall fee, then that'd be in there. And then because I don't think the hardware really, it's a pretty simple hardware, so I don't think it'd be super material to that. Another question, so if you have an agreement such as Office 365 that covers hundreds of licenses, do you divide it down to comparative capitalization policy? I think you'd probably want to, you'd probably look at it as a whole. So you're really looking at that contract level. So it'd be that so if the contract is material as a whole, then you would look at that. You wouldn't necessarily divide it down to if you're paying for certain 1,000 seats at least, a minimum type thing. You wouldn't break that down into each seat. You would be looking at that contract level, similar to 87. Okay, so jumping into the subscription assets. So this is going to be measured at the initial liability, which we calculated earlier. Plus, you'll make any payments made to the vendor before commencement of the subscription term. So, example of this would be if you have to pay a deposit before the contract starts, or any other fee before. And then you'd add any implementation costs, which we'll be talking about a little later, that would be capitalized. Those would get capitalized as assets. And then if there's any incentives that we received from the vendor, so if you're going to get a rebate for it, that would reduce the asset. And really, so this should be amortized in a systematic and rational manner. It'd be either over the shorter of the subscription term or the useful life of the underlying IT asset. So generally speaking, those are probably going to be pretty similar with IT. With IT systems, usually you're not going to be prepaying for a ton. Usually you're either going to be prepaying as a whole, or you're just going to be paying through the entire period. But there could be some difference in there. And then that should be recognized as outflow of resource as an amortization expense. So if a contract enters into a contract that contains both a subscription component and a non-subscription component, you should account for them as separate contracts, unless it's just not practical to do so. And then so if it involves multiple underlying IT asset components, and IT components have different subscription terms, you should account for each one as a separate subscription component, just because you wouldn't want to try to blend it, kind of simpler just to break it out, each of the components. Many times the contract might not really have prices for those individual components. So obviously if the prices are there, then that's a kind of really easy way to allocate it. Though you would want to see if those prices appear to be unreasonable, if they're only charging you $1 for one software and $99 for another, and they're comparable in ability and use, then that would then you need to kind of use your judgment and break it out to more reasonable level between the two. So like I say, so it really is this professional judgment on how you should get those allocated. If it isn't practical to determine the best estimate for price allocation, if you kind of gone through all those steps and you're just not able to really make a reasonable allocation, then you would do it as a single submitta. And then if that's the case, you should account for it as you would do it as a primary subscription component if you're not able to break that out in terms of for the length of time. And then if there's multiple modules within the submitta, as long as they commence at the same time and over the same period, then you would count that as a single submitta, just for simplicity's sake. Okay, so jumping into implementation costs. So there's really 3 stages when you're implementing software. So first you have that real planning time. So that's when you're looking at what software will work for you. You know, what's your needs, what vendor would work well for it if there's multiple vendors you can use for the software. These are going to be expensed as you incur. Don't need to do anything for those. Initial implementation stage, so that's when you're really choosing your software and you're starting to get it set up. So that's the configuration, coding if necessary, testing, installation, as well as any other ancillary charges necessary to place the asset into service. Generally, these will be capitalized as an addition to the subscription asset. There could be some cases where you don't, but generally all of these items would be. And then operations and additional implementation stage. So this is once it's gone live and you kind of more just overall maintenance over time, troubleshooting any issues, and then just dealing with any ongoing access to the asset. Those would be expensed as incurred unless activity meets specific capitalization criteria. So that'd be similar to a capital asset where if you get new change, like if they add a significant new feature or significant new change that you pay for them to do to it, then you would capitalize that. It's kind of the idea of if it really adds length to the life of the asset or capability to the asset, you would add that. And then one other item to note is that training costs at all stages will be expensed as incurred. You don't need to capitalize those. In terms of internally developed software, so 96 did not change in accounting for internally developed software. You're still going to be following GASB 51 for that. Which provides guidance for when those cap outlays incurred at different stages would be capitalized. And then, so these are internally generated some pure software owned by the tribe and reported as intangible assets. SPITAs specifically are a subscription to use another party's information technology. And then kind of as a further note, so GASB 87 had language to help both the leasee and the leaseor with their accounting. GASB 96 is very much focused on the customer, the vendors, that they don't have any accounting for the vendors, especially given the majority of the time your vendor is not going to be even fall under GASB. Most of the time they're going to be for-profit entities, which should be more under the FASB. And then we have another polling question coming up, number 2.
Great, thanks, Jason. Polling question number 2. The following are capitalized costs during the implementation stage under GASB 96, except A, testing, B, coding, C, training employees, D, installation. I'll give you a few minutes to respond. To respond, please click the button next to the answer you choose and hit Submit. If you can't see the Submit button, please enlarge the slide area. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And for those who would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending the slides via email tomorrow, along with the recording of the webcast. You do have the option to submit questions for us by using the Q&A window. If we have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we'll do our best to follow up with you afterwards. And here are the results to polling question number 2.
Okay, thanks. Yeah, so it looks like mostly everyone is picked training employees. 63% of everyone chose that. So yeah, that's the correct answer. So as I mentioned, you're always going to expense training employees under any different time. Testing, coding, installation generally are going to be capitalized. I mean, there could be some fringe cases where you wouldn't, but majority of the time that would be costs incurred to put the asset into service and thus would need to be capitalized. So kind of an overview of reminder of kind of how the reporting works in terms of where it is in the statements. So for assets, you're going to have that intangible asset right to use software. So that's going to be your value of subscription liability plus payments that would be made to the vendor at commencement or prior to commencement of the period. And then also any capitalizable initial implementation costs. And that's reduced by any incentives that you would receive from the vendor. And then you'll have the liability, which is the present value of future subscription payments. And these are, as mentioned, your fixed payments, variable payments that are based on an index or rate, subscription and contact incentives receivable from the vendor that reduce it slightly. Deferred inflows, no real adjustment there. And then in terms of statement of changes, so you're going to amortize that asset in a systematic and rational manner over the shorter subscription term or the useful life of the underlying IT asset, and then you would have the payment of the contract would be the amortization of the liability would be both amortization liability as well as interest expense versus the old software.
Hey, Jason, I just wanted to jump in right here and kind of bring up a question that we had earlier where someone asked if these standards apply to the modified accrual fund financial statements. And I would say, kind of shown here, the reporting is very similar to kind of capital asset reporting. So while you wouldn't report the long-term SPIDA liability or the right to use asset in your fund financial statements, like capital assets, you are going to account for those, current changes. So if you acquired new assets, so new subscription-based assets, or if you are paying on those subscription liabilities, then that information will show up in your fund financial statements, as, similar to, capital outlay or payment on long-term debt. So that's the information that will show up in your modified accrual fund financial statements. And then if you present them, it would flow through to your statement of activities and statement of net position where you're going to show those long-term liabilities and assets. So I just kind of wanted to throw some clarification in there on that one.
Yep. Yeah, good point. And also, I kind of wanted to mention on the slide is, so when you're implementing, you are going to be implementing based off the facts and circumstances at the beginning of the period of your implementation. So assuming you're implementing for 6/30/23 entity, you would be looking at all of the contracts that existed at July 1st, 2022, and then what their facts and circumstances was at that point. If you had any modifications over those contracts during the year, you would deal those with as remeasure as you'd go into the contract modification rules. Okay, so jumping into disclosures. So subscription assets may be grouped for purposes of disclosure. So you don't need to necessarily break out types of subscriptions. You can just have one asset for that. Then you're going to break out the description of terms. So these are going to include conditions in which variable payments that aren't included in the measurement would be in there. So this is where you would put you have to pay this much per seat, or you have to pay this amount for usage by the public or others during each year. So then you break out. So there would be subscription assets. So it would be separate from other capital assets and leases. So you do need to have that broken out. Probably easier to have it as its own just footnote, but you could, as long as it's very clear on which is what, you could have those combined. And then you are going to include payments incurred during the period, and this will include any of those variable payments not included in the measurement of the subscription liability. So these are true. This is what we paid during the year. Then you also show future payments. So this is going to be principal and interest showed separately for 5 years, and then 5-year increments thereafter, similar to what we show for debt. And then if there is any losses associated with impairments or change in the subscription liability, for those agreements that you've determined are short-term, as they are scoped out at 96, you're not required to have them in the disclosure. And then subscription liabilities that are not debt are subject to GASB 88 disclosures. Okay, and then kind of to talk on the modifications. So when you're doing the modification, you're going to count for them as a separate SPITA. So rather than having to go in and reassess everything, you do it as a separate SPITA, assuming there's a couple of conditions that, one, you're giving more than you originally, getting more access to IT asset that wasn't an original contract, and two, that doesn't appear to be unreasonable. So if it's a very large increase that for no specific reason, really no more functionality added or any real other benefit to the tribe, then you would not do that as separate SPITA. And then if it isn't reported as a separate SPITA, the liability would be remeasured with the asset adjusted by the change. So that change in liability would then be added or decreased to the asset. Okay, so I think we have another poll question coming up here.
Great. So polling question number 3, which of the following most accurately describes your organization? A, we have a policy for recording leases and our SBITAS and includes thresholds for capitalization. B, we don't have a policy that covers leases, or SBITAS, or C, I'm not sure. So just as a reminder, if you'd like to receive CPE credits for today's webcast, you'll need to respond to at least 3 of the 4 polling questions. And for those who would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We'll also be sending the slides tomorrow by email, along with a recording of the webcast. And I'll give a few more seconds here for everyone to respond. And here are the results.
All right. Yeah, so seems like kind of split a third of the way pretty much through all the options. So 30 of you have a policy for recording leases and or SVITAs. 30 of you don't, and then a third aren't sure. So we will get into kind of the importance of having those policies set up as Libbe takes over and kind of works you through really kind of preparing for the standards and those lessons learned from 87.
All right, great. Thanks, Jason. As Jason said, we're going to kind of dive into some of the lessons learned from implementing GASB 87 and tips and tricks for using those in your implementation of GASB 96. As our previous polling question kind of alluded to, kind of one of our biggest lessons learned, well, we won't start with that. We'll start with just kind of some of the lessons learned from GASB 87. So I helped several clients implement GASB 87, and one of the things that we noticed was that evaluating the likelihood of renewal or what the term of a contract can be difficult. And you should be able to substantiate if you can conclude that a renewal option will not be exercised, or if you decide it will be exercised, kind of determining what that term is. One of the things that I advise my clients of was that you don't have to create a term. So if a contract is just an annual contract and each year you're going to renegotiate with that vendor to renew that contract, and even if you know that you're going to continue to do that each year, that contract's term is still only 1 year. So you're not going to make up like, oh, I'm going to keep renewing it for 3 years, or I'm going to keep renewing it for 5 years. You're not actually renewing that contract, you're renegotiating it. But if the contract says something like, here's your rate for the first year, and then you'll have an option to renew for 3 more years, then that would be a 3-year term. Or if it says, like you have the option to renew at an updated rate to be determined later, then that could still be considered a 3-year term. So the thing here is that it's important to document why you came to the conclusion that you did and be able to substantiate that based on the contract. Similarly, if a contract calls for payments that are subject to change in the future by an undetermined amount, but that change not based on future performance, so it's not going to change based on a percentage of sales or a percentage of net win, then that contract could be scoped in under GASB 87 and GASB 96. And the future payments are just going to be estimated at the most recent rate known. So I worked with a client who had a lease where there is a set payment, and in the contract it says, this is a 10-year contract, and each 3 years we're going to reevaluate the contract price. It's not based on anything specific. It's just going to be a mutually agreed on new price. And so the client recorded that lease at their current known amount, and then in 3 years, when they renegotiate the new price, they will adjust their asset and liability based on that new amount, depending how impactful it is to the agreement. So if it only changes at a small amount, they might choose to pass on that, depending on their policy. And then another lesson learned from GASB 87 is that interest rates aren't always stated in the contract, and a lot of the times they're not. So you should be able to document why you used the rate that you selected in your evaluation. What we saw mostly was that tribes and casinos and enterprises were able to use kind of their current borrowing rate and say, if we went out and got a loan for it, here's what we would pay. But if your entity doesn't have debt, that might be difficult for you to determine. So it's important to have a policy to determine, what are the interest rates going to be that you're going to use in your evaluation, and how can you substantiate that with your conclusions. Okay, a few best practices we saw. This has already, so this is what our polling question was alluding to. Develop a policy. So most organizations already have a policy for capital assets. And let's say, anything over a certain amount, a lot of times we see anywhere from $5,000 to $10,000 per asset, we're going to capitalize it. You should develop a similar policy for your leases and SPIDAs and determine, at what level are you going to capitalize these assets. You can use the same threshold as your capital assets if that makes sense for you, or you may determine that a bigger threshold makes more sense. We've seen a variety of ranges from people using the same thing as their capital assets. I had one client that picked something like $50,000 because they just felt like the scope of these was bigger, and tracking it, they wanted to have a higher threshold. And the key was that they had the policy documented, it was approved, and they were putting it into place. So they weren't just making it up on the fly when the auditor started asking questions. It was something that they had established and were following. So I don't have a specific, here's the magic number threshold. I think the key is more establishing that threshold and then following the policy going forward. And you can talk with your auditors or your accountants or your advisors to see what they suggest, kind of based on your specific operations, but there is no magic number. It's just more a magic of having the practice. So you want to develop and maintain a process for evaluating agreements on an ongoing basis. So implementing GASB 87 and implementing GASB 96 isn't the final step. These are standards that you have to continue to follow. So every year, every new contract, you're going to have to evaluate those. Does it fall within the scope of these standards, and does it need to be recorded? So make sure that your policies and procedures include a control for ongoing monitoring. When performing your inventory of contracts, include related party arrangements, and make sure you specify whether those agreements are related party or third party. Try as much as you can to have the actual executed contracts on hand for your auditors or for the people making these evaluations, because you don't want people to spend time working on this evaluation using contracts that weren't executed, especially if there were updates subsequent to that version that they received. It could result in rework or coming to the wrong conclusions. And then as we saw with GASB 87, start early and don't underestimate how big of a project this will be, especially with these subscription-based information technology agreements. A lot of the time for us, we don't necessarily work in that world of information technology, and we don't know what all the terms mean. We don't know what all the different elements are. And so it's important to kind of bring in all the people with that knowledge into the conversation so you can be coming to the right conclusions. In terms of, kind of how am I going to start the process? Similar with 87, start with gathering an inventory. So go through your, software expense accounts, go through your, even rent expense accounts, maintenance agreement accounts, and start looking for those recurring payments. Another thing is you could look to what are you currently recording as maybe a prepaid asset and expensing over a year. Maybe those are subscription-based agreements that need to be evaluated. Just gather all the contracts that convey a right to use an underlying asset. And then identify key provisions in the documents. Do they have extension or termination provisions? Are there payment provisions? Be looking for, terms of over a year. Be looking for non-cancelable periods over a year. And then just any agreement that conveys the right to use that asset. And here, bridging the gap, effective communication between your departments is vital to ensure that all of these agreements are being identified. You should be working with your IT department. Reach out to your program managers at those different outlets, in your education department, your construction departments, your natural resource departments, because you may not have a full, grasp of what all the agreements are. if you have enterprises, what are you using at the C-store? Have they purchased, are they subscribing to a point of sale software where someone had asked about like the Square POS systems. A lot of the times, yeah, you're going to get those pieces of hardware, but what you're really paying for is your subscription to that service. So you need to look into that contract and say, okay, are we subscribing to this service? What's our term? Can either of us cancel at any time? And just kind of evaluating each of the elements of that contract to see if it falls within the scope. Okay, and then once we have that inventory, we can start scoping. We can look at so on our earlier slides, we talked about things that were scoped out, things that are short term, or, if you own that software, if you purchased it, then it's not going to be a subscription-based asset. You own it, but if you're subscribing to the right to use it, it might be. Again, develop a policy, establish, what lease and speedos are going to be recorded, and which ones have you decided are, not material or not significant enough to warrant you going through this process each year. And you have to consider the present value of all the payments. With GASB 87, we saw some of these agreements for those leased assets had really long terms. I think with the subscription-based assets, you'll probably not see as long of terms, but, depending how many assets there are, it could add up. Okay, and then our third one is get help. So there are various software packages available to assist with this implementation. One of the questions earlier was, does LeaseCrunch support GASB 96? And it does. So if you purchased a software or you subscribe to a software for implementing GASB 87, a lot of the times those are going to work for GASB 96 as well. But consider the pros and cons of that software and what did you like about using it for GASB 87, and do you want to continue to use it? LeaseCrunch and most softwares will spit out like the journal entries and the tables that you need for disclosure and all of that information. And they usually have a way for you to store and track those leases as well. So I definitely do recommend getting a software if you feel like you might have multiple of these and you want to have something to do the calculation for you, because they are difficult to use. They're difficult to calculate, and these softwares just make it easy just putting in, the inputs. Okay, so quickly we're going to go to our last polling question, and then I'll answer a couple more of the questions that were in the chat. So Lauren, can you do our last polling question here?
Yes, of course. So polling question number 4, how do you plan to prepare for implementation of these standards? And just a reminder, if you'd like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We'll also be sending the slides by email tomorrow along with a recording of the webcast. So we'll give you all a few more seconds here to answer. And here is the result.
All right, those results look great. I definitely recommend increasing the communication between departments, because like I said, a lot of these agreements can be confusing and you may not have a scope of what all they are. Jason discussed a slide earlier where we talked about examples of what could be leases. And as you saw, they can range from, all over the entity. If you're at a casino, what's your marketing team using? What are they using in the cage? Even going down, what is your facilities department using? What types of subscriptions may there be that you don't know about? And just communicating with them and figuring out what agreements are out there. Okay, another question that we got was kind of going back, I think Jason touched on it, but it says if you have an agreement, such as like Office 365 that covers hundreds of licenses, do you divide it down and compare to the capitalization policy? I think it's going to depend what your capitalization policy is, but normally, you would see that, you're not breaking it down to each individual one. You're kind of looking at the subscription as a whole and saying, okay, what's that annual amount that we're paying? Similar to like if you bought like, you know, I work on casinos a lot, so I'm just going to think of that one. So if you bought a big bunch of chairs, you're not going to, usually you don't capitalize each individual chair. You're just going to say like, okay, we purchased these chairs and here it is. Like with the licenses, you purchase all of that, and then you say like, okay, here's our subscription asset. And then like Jason was saying, if there's a modification later that's significant, so if you're adding 1,000 more, or if you're reducing it by 75%, then you might adjust that asset depending on the significance of the change in your right to use that asset. Okay, and then we had a couple questions come in about the certificate, and we'll get the certificate corrected so that it has the correct date. Okay. All right. Let me see the questions. I think we've answered most of the ones that I can in this webinar. You know, we do have another slide here that's got some resources on, well, it's got our contact information, but then resources that are currently available from Moss Adams. And then, as always, we encourage you to, you know, reach out to us if you have any questions directly, or, you know, reach out to your current auditors or advisors, and they can help you with implementation. Let's see. I've got a couple more questions come in. Okay, so one says, with accounting software, it's an annual contract, but obviously they will renew it. How do they pick the term based on the current annual rate? So kind of like I was saying before, you don't have to invent a term, but if you decide, okay, we're definitely going to renew this and we want to record it, you would record it at the currently known rate. And then depending on how much it changes, you would evaluate that each year and say, has there been a significant modification to the asset I recorded, and then adjust that. So if it's not really a 3-year contract, I would recommend not recording it as a subscription asset and liability. But if you believe that it would be, and based on your policy it says you should, then you would use the rate that's currently known.
Yeah, I was going to say, and the difference between what you estimated and what you end up paying would just be kind of, and that would be considered part of that variable consideration that you would disclose, but not necessarily have to change the liability for, assuming it's not significant.
Okay, yeah. And I think that is all we have time for today. Thank you, everyone, for joining us. And Lauren, is there any kind of closeout thing for us to do here?
Yes, thank you. Thank you, Libbe and Jason, for a great presentation today. If we don't have time to answer your questions, we'll do our best to follow up with you after the webcast. So feel free to reach out to your presenters if you have any additional questions. If you met all CPE requirements, your certificate is available to download now. We are aware of the date issue, so we will make sure to be sending out an updated version in 2 weeks. And for those who would like a copy of today's slides, you can download them from the folder that says slide deck and handout. And we will be sending the slides out tomorrow via email, along with the recording of the webcast. And finally, here's a link to an online survey for today's presentation. Thank you all for joining our webcast, and we hope that you'll join us again next time. Take care, everyone.